Hi, this is James Hugg at Westpac with the end of day report for Thursday, July the 5th. Well, within the space of 45 minutes at lunchtime London time today, we saw three central banks ease monetary policy. The first to go was the Bank of England with an additional 50 billion sterling worth of asset purchases announced over the next 4 months. That'll take the total Bank of England asset purchase program to £375 billion. The bank cited the increasing risk that European concerns would risk inflation undershooting the 2% target in coming years. Exactly the same time, the People's Bank of China cut its benchmark rates. The benchmark lending rate was cut by 31 basis points and the deposit rate by 25 basis points to 6% and 3% respectively. 45 minutes later, the European Central Bank cut its repo rate a further quarter point to 0.75%. That's the lowest, it's an historical low for the ECB actually. They talked about downside risks to the outlook materialising and heightened uncertainty. Now, as you probably regular viewers would know, we think that the ECB will ultimately embark on a form of quantitative easing, but there's no hint of that yet in the press conference, with the ECB chief Draghi saying that he didn't want to risk the credibility of the bank by doing something that he saw as being outside its mandate. As we've always said though, they'll keep denying it until the day they actually do it, and that day is probably going to be before the end of this year, I think. On that point, Spanish bond yields jumped more than 30 basis points today. Italian bond yields up more than 20 basis points because there was no real hint that something might be done by the ECB to help hold down those yields. Recall, of course, that the ECB has suspended its securities markets program where it was buying the bonds of European governments some months ago now. In terms of economic data today, we saw the US non-manufacturing ISM survey for June. It fell from 53.7 to 52.1 in June. That's quite a big drop. This is its lowest reading since early 2010. And just like we saw in 2010 and 2011, confidence that built up in many of these business surveys in the early part of the year failed to sustain, and it's happening for the third year running now with this survey and many other US economic surveys. In contrast, the ADP private payrolls measure of jobs rose 176,000 in June. That's the strongest number in the June quarter, but still weaker than the previous 5 monthly figures in November to March. So there's still quite a quarterly slowdown in place between Q1 and Q2, but nevertheless, that measure of private payrolls is running ahead now of where the official payrolls figures and private payrolls figures are running at. The June numbers there come out tomorrow, and our forecast at 130,000 is above the consensus, and the ADP number kind of supports that, although the two don't always track perfectly. German factory orders up 0.6%, but still down 5.5% over the last year. The last time they were running that sort of decline to that sort of pace was during the 2008 recession. Yet another indicator that Germany indeed is in recession, not just broader Europe. And that's about it really on the data front. Oh, we had a few other labour market numbers in the US. Initial jobless claims down 14,000 in the latest week to 374,000, and corporate layoff announcements down 9% compared to a year earlier. But also US chain store sales growth slowed to just 0.2% annual in June. That's its lowest pace since late 2009. So apart from the ADP and claims, softer numbers in the US, easing from Europe, UK and China, you'd think that with all that easing and with the strong jobs number that markets would have done okay today, but they really seem to have focused on the risk assessment from the ECB, where they said that heightened uncertainty and, as I said earlier, downside risks materialising to the outlook. I mean, and that's why, frankly, markets are mostly down. I'm just heading into the European close. we've got the London market up 0.2%, but the French market down 1.2%. The German market down 0.5%, the Spaniards down 3%, and the Italians down more than 2% today. And in London, in New York, sorry, the Dow is down about 0.25%. That's just coming up to 5 o'clock London time. The commodity markets, further losses on top of yesterday's pullback from Tuesday's solid gains. Copper down 1.3%, gold down 0.75% at $1,610 an ounce, and oil off a pip at $87.64 a barrel. And the Aussie dollar is marginally higher, 1.0293. I mean, when the Bank of China cut, went up through the roof. Skyrocketed way above 1.03, but it's just back below that level now, and actually not much change really from where it has been over the last couple of days. That's it for me today, other than to remind you that we've got the monthly jobs report for the US, the official data that is, coming out tomorrow. I'll be back to report on that then.